I'm going to share with you the 21 principles of trading. These are the rules that separate amateur day traders from the top 1% who consistently pull profit from the market. Some of these, they are the same ones I've used to make my first $1 million in trading, and they've been carved out over 21 plus years in the trenches. Because look, there's only three things price can do. It can trend, it can chop, or it can trap you. And if you don't know which one you're in, you're going to bleed. But once you understand structure, you can stop guessing and start waiting for the money to walk into the market. So these are the 21 principles of day trading. Let's go over the principles. Principle 1, price is fractal. When I started day trading, I really thought that I had to separate every single time frame and that every time frame was different. But what I ended up learning was that every setup repeats across time frames. You don't need to get stuck in some 1 minute chart where it's just all chop. You want to move on to bigger time frames because you're going to see clean patterns. But what you'll start to notice is the larger the time frame, the cleaner the patterns and the higher the probability. And then you can start to narrow things down into the time frame that you're willing to trade. Principle number 2, there are 3 things that price can do. You can either trend, you can chop, or they can trap you. That's it. Define it early. Guys, getting on the right side of this is the key to everything. My biggest losses in trading have always come from not understanding trend alignment. I keep going in big when there's no trend, and I'm either getting trapped or I'm getting trapped. And that's where the suckers come in, and the real players are making their money. The real hotspots in trading are not when you just draw some squiggly line on a chart, but it is when you recognize that a group of traders have been trapped and you are going the opposite way and taking their money. Fake breakouts and fake breakdowns are the number one setup in a market, especially a bull market. So many traders are just taught to draw squiggly lines on a chart and they think that's what makes them money. But what makes you money is thinking in 3-dimensional ways. Where is the real likelihood going to come from making money? And that is when the traders get trapped. Another thing that you need to know and understand is structure over speed. Oftentimes we see these big candles and we think that's what we have to trade. And we end up jumping in to these big candles and we end up getting into the trap setup. When you look at a trade, you have to think of it holistically and look at the overall structure. Are you making higher highs and higher lows? Are your moving averages trending up? And then are you entering close to a base? Oftentimes when you see the big candle, you think that's the breakout. No, that is the liquidity event where the pros are unloading their shares on that big candle and you're buying and then you get stopped out. A real important thing is anchor your bias off a higher time frame. This theory is called aligning stocks on multiple time frames. It was made popular by Brian Shannon back in 2008 in his best-selling book. I've been following it ever since. And what the theory is, and I implement this every day, is that you want to get your ideas from the big picture. So your big picture chart, for me, it's the daily, is where I get my ideas of what I want to trade. And then what I start to do is narrow down the time frames to really have precise entries and exits. So I may use something like an hourly time frame to manage my risk on a trade, and then I use a 5-minute chart to really pinpoint that entry. I tend to stay away from the 1-minute charts because you'll see dead bodies everywhere. Like everything looks like a pattern. But guys, remember, you're in the game of making dollars, not pennies. Too many traders get caught up in the game of pennies versus dollars, and they get into the 1-minute charts and they're selling and buying everything for 10 cents. That's not how you're going to make your money. If you read any book, talk to any big trader, they made their millions from big, juicy setups, right? And so you got to look higher time frame and then start to narrow it down. And that's how you get precision. And that's how you're going to get elite entries and profits. Now, let's talk a little bit about price action, because price action is what confirms structure. Guys, when you have a breakout, it's just a candle. It's just a piece of graphic on a chart. But that graphic, that candle, is not validated till you have volume behind it. That's what gives it structure. Volume is a measure of the emotional intensity of traders. Volume is a measure how bad traders want it. It is what confirms price. Price is just price. But what volume does is it assigns meaning to that price movement, to that big candle. Now look, false breakouts come from weak context. If a breakout doesn't have a big base or is some type of buildup behind it, it's most likely going to fail. So many traders just look at high of day or high of the month or the high of the year, and they call that a breakout. But that is a setup without structure and without a base to it. If you just draw a line at the chart and you say like, wow, this is the high of day, I'm going to buy it. Or wow, this is the high of the year and I'm going to buy it, you are going to have a less than 50% win ratio. I lived this when I was a new trader. I read all the books on trading from William O'Neill and on, and every single one of these books always were like, okay, you draw a line at the top and it breaks out the highs, therefore you make money. But what I noticed is every time I did that, the breakout would fail. I lose money after money. Why? Because that breakout had no structure. You need a base, and you need your moving averages really tight underneath to provide the support so that that base and that breakout actually has explosion. That's why I believe you need 3 tests of resistance to actually have a real breakout, and you need that 9 EMA curling under the breakout. Guys, that is your signal on whether a breakout is going to be real or not. So the thing I always tell my students is if it ain't tight, it ain't right. Meaning I want that 9 EMA curling right up under that breakout, and that's when I know for sure that the breakout is going to work. If the 9 EMA is too loose, if you just literally fit your thumb in it between price and 9 EMA, that breakout fails every single time. Now look, one of the biggest things that you need to do is wait for compression before expansion. Guys, the best moves come after the quiet. You need to know the difference between noise and buildup. Guys, noise is just chop, it's fake outs. But what buildup is you're building structure inside the chart to provide power and explosion. Guys, stocks get their power from basing and consolidation. That basing and consolidation is the whole explosion that happens behind moves. If you go back 100 years in the stock market, every single big breakout came from one thing, a big base that had structure behind it. So what's the difference between having structure behind it and just chop and noise? You want to see inside the base, your moving average is starting to curl up. You want to see that 9 EMA, that 20, they start to just drift higher. You're starting to make higher lows inside the base. So what's happening is what traders are looking at, they're just like, wow, it's chop, it's a base. No, inside that chop, the real traders are looking at it and saying, holy crap, there's something happening in here. Inside the market, you're building the structure. And so when that 9 EMA starts to curl up inside the base and you start to tap into that high, into that range break, that's when you actually have a buildup versus chop and you're going to get a breakout. Guys, what moving averages do is if they allow you to see trends on different time frames. So what you need to do is see the moving averages curl up so that you know that the trend on that time frame is higher. So your 9 EMA is your short-term trend. So when it's starting to curl higher, you know the short-term trend is higher. So that's when you know that it's a buildup versus chop. If it's chop, your moving averages will cross over back and forth from over, under on each other. But if they start all aligning together, you're building structure. So look, once you understand structure, your next edge comes from managing execution and managing risk. That's where most traders blow up. So let's fix this right now. These next 7 principles are what keeps your account live and scaling. Guys, your number 1 job is risk manager, trader second. When somebody asks you what you do for a living, for me, I don't say I'm a professional day trader. Even though I've been day trading in and out of the trenches since 2008, literally running the world's longest running live trading course, the 60-day boot camp, my job is not as a day trader. My job is to be a professional risk manager. We are here to survive and thrive. And the only way you can do that is by managing your risk aggressively. There's no point in your career when you're new where you have to risk it all on the line in one trade because you don't have the experience and you don't have the data to actually back up that trade. where you're like, wow, this is actually something that's an all-in setup. That would come with 10, 20, 30 years of experience. Otherwise, your job is to build your account $100 at a time, $200 at a time. I know that sounds boring, but think about it like this. Our students are all over the world. If you make right now $200 a day, how does that change your life? Guys, there's 22 trading days in a month. At $200 a day, that's $4,400. That pays your mortgage. That pays your health insurance. That might make your car insurance, but that is a real life-changing money. Now, I'm not saying you got to make $200 a day forever. But what I'm saying is that's a great start, and people discount that. They say, like, I need to make $1 million. I need to make $2 million. But what they don't think is, like, how different is your life if you were just able to pay your mortgage, if you were just able to pay your health insurance and your car. $200 a day does that for a lot of people. And that's an addendum. It's just a start. But the reason that the traders fail is they go for the big versus going for what actually makes impact. And that's called taking income out of the market. So your job right now is to be a risk manager, not a day trader, not a swing trader. We've got to go and attack the market with precision every single day. So let's talk about a few tenets on how to actually do that. So how you're going to do that is you want to have a fixed risk per trade and dynamic size. What I mean by that is that people often have fixed size versus fixed risk. Fixed sizing is, hey, I buy $10,000 of everything, or I have a $20,000 account, I put it in everything. That's a fixed sizing. It's a fixed mentality. We want to have risk-adjusted sizing, meaning our risk per trade is the same. I'm risking $200 per trade, $500 per trade. But what happens is your sizing will be dynamic, because when you have a big juicy setup with low risk, you're going to have a shitload of stocks. You're going to have a shitload of shares. You're going to be all in on this thing for that particular risk sizing. But when your stop loss is loose, you'll have less shares. So in layman's terms, what does that mean? If you have a $500 risk per trade and you have a $1 stop, you're going to have 500 shares. If you have a 50-cent stop, you're going to have 1,000 shares. So what you're doing is sizing based on your risk. No matter what, when you get stopped out, you're just going to lose $500. Now, that's a sizing I would recommend if you have a $50,000 or $100,000 account, not if you have a $10,000 account. If you got a smaller account, go $100, $200 risk per trade. You'll thank me for it later, and you'll still be able to make big bucks on it. So don't discount risking $100, because you can still rip $1,000, $2,000 on some trades. Now look, everybody's always talking about entries. But one of the big things is you got to plan your exit before you enter. I know thousands of traders. I've taught 7,000 over my life, and most of them know entries. But you know what they don't do is they don't plan for the end. You should know your exits before you even enter a trade. That's how you're actually going to get good. I've had student after student that have the best picture perfect entry, and they end up making 50 bucks on a trade, 100 bucks on a trade. And they're like, hey, I won. Green is good. Profit is profit. Guys, green is not good and profit is not profit. If you make 100 bucks, but you could have made 2,000, it's a bad trade. If you made 50 bucks, but you could have made 500, it's a bad trade. Green is not green. So what you need to do is plan your exits before you get into the trade. How do you do that? Use support and resistance lines and then a dynamic reasons to sell list. Hey, if I'm making higher highs and higher lows, I stay in the trade. Hey, if I'm riding over my moving averages, I stay in the trade. But once you start to break down the structure of the trade, now all of a sudden, it's an easy way to just get out of it. Now look, this is a hard one, but it's so important. Guys, you have to trade the setup, not the feeling. In markets, 2 or 3 months of the year, FOMO kicks over. You'll see stock after stock exploding, right? We were literally trading this stock SBET the other day in our chat room, and it was at whatever, 10, 20 bucks. The next day it's at 40 bucks. We take an intraday breakout on it at 47 bucks, right? It goes to 60, goes to 70. Now I'm not in it anymore. But the crazy thing is, so it's now at $80. It was at just a handful of dollars the day before. And you know what everybody's doing? I never get that many messages on really good setups. I get message after message from my students saying, should I buy this? Is it going to 1,000? What does that tell you? People are trading feelings, not setups. Guys, you had an opportunity to buy this at $10, $20, $30, $40, and so on and so forth. Now it's at $80 and you're blowing your mentor up saying, should you buy it? So you're not thinking about setup. You're not thinking about pattern. You're not thinking about risk. You're just thinking about FOMO. You're thinking about feeling. You're thinking about that gut that's happening in your stomach where you're like, man, everybody's making money but me. Can this go more? So you need to always come back to stock trading. Guys, most traders, they trade their hopes instead of their patterns, right? We're trading our hopes and dreams more often than we're trading our patterns. You know, my mentor used to tell me that all the time. He said, no, you're not trading stock patterns. You're trading your hopes and dreams. You have goals. You want to get hair plugs. You want to get a Porsche. You want to look hot. And that's what you're doing. So you're going in and trading feelings, not setups. Right now, I'll tell you something that'll save you so much money, you will double your profits. If you write down the name of the pattern before you get into any trade, you will cancel out so many of your bad trades. No pattern, no trade. Like literally just write it down. Is it an ORB? Is it a quick pullback buy? Is it a flag pattern? Is it a flat top breakout? If you can't name the pattern, then you have no structure behind it. It's going to be a dead trade. Guys, no pattern, no trade. Same thing for setups. Now look, this is the big boy. You gotta let the A+ setups pay you. Every trader I know, when they get the juicy setup, the one that you've been waiting for days, weeks, they scalp out of it. They scalp out of everything. And it doesn't even matter the time frame. I met traders that'll trade on like 60-minute time frames and they get a whoop, 50 cents. They're like, I'm out. I made some money. Here we go. No. When you have the A+ setup, and those come maybe 2-3 times a month, you can't scalp out of it. And that's what goes back to the previous tenet, that previous principle where you have to know where to exit before you enter. That's what the pros really do. Guys, I'm telling you right now, after 15 years plus day trading in and out, I made over 100,000 day trades in my life. You get A+ setups 10 times a year, maybe 20. So if you scalp out of those setups, you may have made green on the stock, but you're actually losing. It's opportunity cost. You're never going to get where you want to go. You can't nickel and dime your way to millions of dollars. You just can't. And so at some point, you got to have the big setups. So when you see it, write it down in the morning. This is where your trade journaling, your pre-market planning come into fruition. You see that A+ setup? It's time to go for gold. Now let's talk about losses. Micro losses compound into confidence. Guys, one of the biggest mistakes that traders make is they are afraid to lose. Not because it's the $50 bothers them or the $25 bothers them or whatever. It's an ego thing. We think that if we lose on a trade, therefore we are losers as people. And so we don't like taking losses. I do it myself even today. I got to train myself out of it. I'm literally being a trade and I could be down like $50, $100, and I'm like watching it sometimes like, man, if I just get $2 on this, right? And it's like, right, like, what does that do? It's just ingrained into us. We think that if we lose on trades, that we are losers as people. And we've got to always be careful about that. So get used to taking small losses. So let me tell you a little lesson that my mentor told me in 2006. I refused to use stop losses. So Paul said, Kunal, why aren't you using stop losses? I said, well, I don't want the market makers to take my money and this and that. He said, I think it's just because you don't want to accept the loss. So I said, okay, what do I do about it? He said, your next 100 trades, I want you to just buy 10 shares of every stock. And I want you to use a 10-cent stop loss, no matter what. So I said, okay, I'll do it. So I take these 100 trades. I got stopped out of every single one, literally 100 for 100. And he goes to me after, he goes, what did you learn? I said, well, I got stopped out of every trade. He goes, yeah, but was it a big deal? How much money did you lose? I'm like, nothing, like $50. He's like, exactly. Taking losses doesn't mean you're actually taking losses. It just gets you closer to the big wins, and that's where your real edge grows. Now, look, let's talk about something about the big picture that's important that most traders forget, especially if you're into small caps and all this kind of stuff. They never look at this, but it's so important. The setup is not actually the trade. The market itself has to validate the trade. Until then, it's just a picture. It's just a little graphic. No matter what type of trading you're doing, small caps, large caps, futures, so on and so forth, there are cycles for each instrument. Small caps go through cycles. Guys, if you're a crypto trader, you know they go through cycles. I mean, they go through the biggest cycle. They get hot, and then they top out, then they die. Over and over and over. So what do you have to do? You have to have the market validate your setup. Until then, it's just a picture. So going back to this, guys, you need to make sure, like if you're swing trading, day trading, you're trading with the proper market cycle. If you're in small caps, you want to make sure you wait for the small cap cycle. If you are in cryptos, you want to only trade in that one crypto cycle. Crypto only has one good cycle. And when it hits, people make millions. And if they don't cash out when that cycle ends, they lose it all and then some. So letting the market validate your setup is one of the keys to trading with the wind behind your back. So look, once you know how to execute, what separates the top 1% is how they think. What's their mindset and what are the things they're doing to actually build that mindset? These final 7 principles are all psychological. Miss them and nothing works. So look, you're building a career, you're not playing a game. What's happened because of like YouTube and video games is everything is turned gamified, right? It's a gamified life. Hey, I'm going to gamify my career. I'm going to gamify my day. I'm going to gamify my workouts. But guys, that's not realistic for this. This is a career. It is no different than being a doctor or a lawyer or some high stress, high money profession. This is not a game. I promise you that this is not some like video game that you're going to play and then you make a bunch of money. You need to treat this like a pro, like it's your career. Think about it like this. How much school and how much money does a doctor spend before they ever make their first dollar? Hundreds of thousands before they make their first dollar. How much study do they actually do? A dozen years. I'm doing is saying you need to take this dozen years, this hundreds of thousands of dollars of experience and cram it into 60 days, 90 days. So it's an intense amount of work. So you have to come in like this is a career versus a game. Now look, you need your edge to be repeatable, not about prediction. You don't need to guess what happens after a period of time. You need repeatable processes that pays over time. Guys, having repeatable processes over time is what actually builds your stats. So a lot of traders will come and go and they'll have a hot win and they have a hot loss. And the reason is that they were just depending on a lucky market to get money. What you need is setups and processes from routines that actually allow you to do the same thing day in and day out. And when you do it for years and years, that's when the wins really come. Now look, let's talk a little bit about revenge trading because this is the thing that's getting all of you guys, gets me too. Guys, revenge trading is most often a trust problem. You're trying to get back something that the market never owed you. Because the market's not a person, right? And you're nothing to the market. But oftentimes, like we look at trades and say like, man, I got to get my money back on this trade. Oh man, this stock owes me. Guys, I've been streaming for 17 years and I still will say it sometimes on stream like, guys, we're shorting this pound tart today. This little bastard owes me. And you know what happens every time I say that? I lose. The market is just the market and you're just you. And our job is to find repeatable setups and processes we can repeat. But the whole like get your money back thing, it's never going to work and it never has. Now look, this is big because this is something you can do right now, every single one of you guys. Discipline is a muscle. You can grow it. The more you follow your rules, the easier it gets. Don't skip the reps. It is no different than building any muscle. It takes day in and day out, and then what happens? It gets a little bit easier. And discipline is like that too in the beginning, so don't skip the reps, guys. When you look at discipline, it's not something that has to be a chore. It's you do this for 2 months right now, 3 months right now, and you coast the rest of your life. You don't have a discipline problem. Guys, I'm the most undisciplined person in the history of the world sometimes. I didn't get married till I was 44 years old, right? But look, and when it came to my trading, I did the hard thing in the beginning so that I could have the easy things later. And that's how you have to look at now. Taking losses sucks. Following your rules sucks. Going on a diet sucks. But guess what happens? At the end, there's something good. And your discipline is going to be like that. Now, guys, look, your ego wants to be right, but your account wants and needs to be paid. Choose which one you listen to. Guys, your ego is meaningless. Let me just say something. We all live a life of ego. We all think that we're the center of the universe and that we are the hero to our own story. And I think that about everything. It's all in our heads. We think that people are looking at us, that people are judging us, and so we have this ego about things. But there's no such thing. Nobody's looking at you. Nobody cares about you except maybe 1 or 2 people. And so your ego is meaningless. But your account is true because it can't lie. I'm at 50,000, I'm at 52,000. This account can't lie. It needs to be paid, it needs to be fed. And when you feed it and you start taking withdrawals, the dopamine starts to hit you. This is the boring but important part. You guys got to journal even when you don't want to. You know what? When you take a big loss, you know what you usually want to do? You want to take the day off, right? You're like, I got to get my head straight. I got to go to the beach. I got to meditate, whatever it might be. right? We have like this process that we use to heal ourselves. And so you don't want to ever journal when you take losses, but that is the time that you want to journal. The money is made in doing the boring work, doing the work when nobody wants to. If you talk to any successful person, they will tell you, I made my money when I was doing the things that were uncomfortable to me. I was doing them when I absolutely hated doing them, and I still did it. I still got up in the morning. I still journaled my trades. You know, the journal is the journal. Look, when you take a big loss, it's not like you have to write some journal about it. You know what you did. I oversized, I held too long. It's all the same 5 things. So the journaling of the trade is not really to learn about the trade. It's about doing the nitty-gritty real work when you don't want to. That's how you're going to make money, and that's where the real growth is going to come for your account. Now look, let's top this all off. You always got to remember one thing. The market owes you nothing. If anything, it's going to take something from you if you don't prepare. Entitlement, it kills traders. You got to stay humble. You got to stay dangerous. You got to get in and do that nitty-gritty work every damn day, whether you want to or not, because somebody else is doing it. Think about it like this. I've been trading since 2008 full time. If I'm out working you right now and I'm going to work my ass off tomorrow, dude, how you going to beat me? How you going to beat anybody? So you got to go out and take it every single damn day. The market owes you nothing. So you got to be humble. You got to respect the market, but also respect the players in the market, because those are the people that are going to take your money. So how do you beat somebody that has more money, more experience than you? You got to outwork them. In the beginning, that's all you got. You got to outwork them. And so you do it every single day, you're going to make moves. If this helped you and you're ready to take your trading to a whole new level, click the link below and apply to our trading bootcamp. It's a 60-day trading course that's designed to take you from A to Z to become a pro trader in less than 60 days. And it's all live. No on-demand, no recordings, none of that BS. It's me and you and some real mentorship.